Key equity hedge update here, 15th of April. We're almost at the end of the expiry period for 2010, which is the third expiry period, which is the 16th of April. So we'll just take you through. We have one more day of trading left and our strike point's at 12.15. So I'll just explain the scenarios. So we're currently on the morning session of Asia at the moment, so it's well in the morning there in US. So we have one more day of trading to go, which is today's trading period on the 16th of April, and then we've got a sold call position there at 12.15. Now I can't go into massive depth of each and every position around that 12.15, but that is our first strike point at 12.15. There's another one at 12.20, which is I can go into that after tomorrow, if it goes through the strike point. So for now, we want the market to land inside or underneath this 12.15 to make sure we get full premium off our spread. And since we've had this rally, we're in a long trade from 11.81.50. So we entered where this grey line was back here with our indicator, and we now have dragged our stop up slowly as the market's progressed in the upward direction, and we hold the underlying futures here as our hedge. So let's throw a scenario in. We get into trading today, we get a sell-off, we stop out, we close underneath our 12.15 strike point, we get full premium on our options. We've made money on our futures this month, so that's the sweet spot where it hits. Let's say option 2 is the market rallies up, closes above our strike point. We lose on the options trades, and depending on how far above that closes in the money, the options positions there turn into futures the next day on the Monday, and then in this spread we've got 3 sold large S&P positions. So we're holding the futures underneath, so we've got 3 large S&Ps that are sitting there up there now, that will now be in a sold position if it closes outside the strike point at the end of today's session. But we are also holding positions from 11.81. So we continue to hold those positions until we get stopped out. So there's nothing saying that the market won't keep rallying and we stay in this trade, and we still can't set another options trade until we get another entry anyway. So it doesn't really matter. If we go above and close above our strike point, it's a loss on the options while we're holding our futures, and we're just going to make that money back on the way up anyway. So that's the whole point of having the hedge. So it's a great position to be in as an example. So you can check this again tomorrow. So it's touch and go at the moment. 12.15 is a strike point, so it's transparent. I'm not going to say it's not. That's our position. So you can see it in real time how this system works. As our underlying futures, which is this indicator below, that is the key to our success, and that's the hedge, and that's what's going to make money on the way up when our options are a loser if we close above the strike point. So at the moment, our current position, we're about 3%, and we have that position there at 11.92 as our current stop, so we're 10.5 points in the money. So thanks for listening, and we'll go again tomorrow for an update on what happened, and it's going to be a very interesting night.